You're about to join Niels Kaastrup-Larsen on a raw and honest journey into the world of systematic investing and learn about the most dependable and consistent yet often overlooked investment strategy. Welcome to the Systematic Investor Series.
Welcome back to this week's edition of the Systematic Investor Series with Alan Dunne and I, Niels Kaastrup-Larsen, where each week we take the pulse of the global markets through the lens of a rules-based investor. If you're new to the show, I hope today's episode will trigger your curiosity enough to check out the back catalogue and listen to the past episodes that you may have missed, like last week's episode with Jerry Parker, where we talked about finding the optimal way of doing trend following, and even discussed how to react to a drastic fall in a market like what we saw in Luna just a couple of weeks ago. Also, I would like to encourage you to listen to the midweek Global Macro episode where Jim and I had Joseph Wang, who's also known as the Fed guy on Twitter, take us inside the Federal Reserve as he was sitting on the open markets desk for 5 years. And we discussed the challenges that central banks face at the moment in the current environment. Very interesting insights indeed. Now, as you may know, the aim of the podcast is to inspire you to be the best investor that you can be. We want to be provocative from time to time, but without being polarizing. And we want to challenge consensus narratives and to advocate how to think critically about investing in an uncertain world. And we want to provide you with a framework and a mindset that we believe is truly robust. Alan, it is always a great pleasure and a lot of fun to be with you. So welcome back. And how are things where you are today?
Thanks, Neil. So always a pleasure to be on. It's beautiful sunny morning in Dublin. So looking forward to the rest of the day. But also looking forward to chatting, a lot to catch up on.
We have quite a few things to talk about, so I can't wait to dive into some of these topics that you brought along. Before we do so, of course, let me just quickly run through what I noticed happening this week, and then we'll hear a little bit about the things that you've noticed also in the past few weeks. But to me, of course, fixed income and bond prices are the center of attention at the moment. And this week, they continued to rebound a little bit. In particular, in the front end, the yield to maturity on the US 2-year notes declined another 10 basis points last time I looked. 2.49% is where the yield is. And the 30-year bond remained the same, more or less, at 2.99%. The steepening of the yield curve is a result of participants expecting a slower growth and lower inflation going forward. In essence, participants have removed future expected rate hikes over the course of the next year, effectively recalibrating the terminal Fed funds rate lower. Now, the mid-month equity swan and the string of earnings misses that we saw also added to the bullish sentiment in the front end of the curve. The FOMC will begin, by the way, to reduce its balance sheet next week, the so-called quantitative tightening, or QT. This will effectively remove the largest price-insensitive buyer of US Treasuries and mortgage-backed securities from the market. And with inflation as measured by the CPI running at 8.3%, and it has been, by the way, above 2% year-on-year for more than 16 months now, and the core PCE running at 5.2% year-on-year, you may have to ask yourself if a 2.73% yield on a 5-year maturity in the US makes sense. From what I remember, at least about Q4 2018, I think the impact that the shrinking of the Fed's balance sheet is going to have on liquidity in the credit markets could be quite significant, and that this may be extremely painful in the credit markets. But as always, time will tell. Alan, it's been a few weeks since we last spoke. I'm interested in hearing what has kind of caught your attention in the last few weeks.
Yeah, last time I was on, we were very much focused on currencies and the big move up in the US dollar. And, in the last couple of weeks, we've seen an interesting corrective phase set in with the dollar, which is interesting. And I think it's probably tied to what you've alluded to there with a little bit of a repricing at the front end of the curve with respect to Fed tightening. What's interesting around all of that is we've had some Fed speakers in the last couple of weeks raising the possibility of Fed rate cuts next year and beyond, which I find fascinating that we're just about at the start of the tightening cycle and we're already talking about rate cuts. So it seems like the Fed is involved in an interesting dance with the market here of trying to manage expectations. Of course, by raising the prospect of cuts, that kind of eases financial conditions. And that might mean they might ultimately have to do more tightening. So it's a fascinating back and forth between the market in terms of managing expectations. But certainly there is a sense that they were trying to take some of those tightening expectations out of the markets. And, it felt like for a long time people were looking for this bear market rally. And obviously it looks like we're starting to see it in the last couple of days. So whether those, this kind of, I suppose, kind of Goldilocks type scenario of bringing policy slightly tight and then ultimately easing, that's kind of what's been alluded to. Whether that actually plays out, that remains to be seen. But that's by and large what I think the market is pricing at the moment.
Yeah, just a couple of thoughts as you were speaking that came to mind. Obviously, closer to your home for sure. I couldn't help noticing that the Bank of England governor has been out since we last spoke. I think maybe it was mid-May, saying that he felt pretty helpless when it came to taming inflation. And of course, inflation in the UK is expected to hit 10% later this year. And then I think there was 24 hours later, there was a politician or a minister maybe that came out and said, he was very surprised that the Bank of England was helpless in taming inflation. That doesn't sound well. Yes. In my ear. And the other thing, I kind of feel that there has been, of course, some chatter in the press about the S&P briefly hitting the minus 20% from its last peak, and therefore in bear market territory if we go by that rule. And of course, we know the Nasdaq has been in that territory for a while. But the question really is to me: is a bear market just something we define by a minus 20%, or is it something we have to feel? Because this doesn't feel like a bear market to me, frankly. I'm sure for those who've been in some of these, ARK funds or Zoom or whatever they're called, these stocks, they will feel it. I have no doubt. But if you look at the S&P 500, generally speaking, if you look at sort of what's going on, it feels more orderly. It doesn't feel panicky. And therefore, it doesn't feel like some of the bear markets we've seen in the last couple of decades. So I don't know what do you sense the same thing? Or
yeah, I think you're right. I mean, it's interesting. Howard Marks has a new note out. I was just scanning it out this morning, and he touches on the same point. This preoccupation with whether the S&P hit bear market territory or not. I think his letter was more about the bull market and the definition of a bull market, and more the bull market definition should be more about the market environment and the psychology of the investors, as opposed to any kind of statistical measure. But equally, I think with respect to bear markets, he called them, they feel nerve-wracking. So have we hit that point yet in this downturn? I agree with you. If you look at some markets, the FTSE's not massively off its highs. Depending on where you are in the world, obviously if you have a portfolio focused on US growth stocks, it's been painful. But for lots of investors, I would tend to agree with you. There's probably not a sense of widespread pessimism and despair yet. So yeah, is it a bear market even yet? Yeah, that's an open point. But certainly, I do get the sense that the sentiment for the kind of investment research I read is people looking for any move up as a corrective move, as opposed to not reading a lot of people saying, "Oh, this is the buying opportunity for a new leg in a bull market."
Yeah, I mean, I would concur with that for sure, and I think generally speaking, given my framework of where I think the world is heading, I think we need to kind of change our mindset a bit from buying the dip to selling the rally. I think that's probably more the world we're going to be in, but who knows? I could be completely wrong, of course. In terms of trend following this week, I suspect that it's probably been a flat to slightly negative week for the industry, mainly for one of the reasons that you mentioned, the weakening dollar, and also, of course, the fixed income market selling off a little bit in terms of price. And of course, depending on how loose your trend following pants are, I would imagine the equities were either a small winner or a small loser, depending on whether the models have been sort of going short a little while ago, or whether they're still hanging on to this quote unquote bull market, at least in some countries, I would imagine. But I do think one thing is worth noticing, and that is that the biggest contributor this week, I suspect, would have been energies, because I noticed that many of the July contracts, which is the front month in many of these markets right now, some of them are making new highs for 2022 above the March high, and most others are very close to doing that, even though if we all remember that oil hit $130 on whatever 8th of March, but actually the July contracts only got to about where they are now, and now they're making new year high. So inflation, if you look at it in that sense, is not going to get any help from energy right now. Other sectors in the portfolio, as far as I can tell, were pretty flat. I did notice, though, that my trend barometer, for the first time in many, many months, finished the week pretty weak, actually, at 34, which is certainly below neutral. But we'll see. We are in a corrective phase for sure. So we'll see if it's going to just finding a little bit of new juice and will come roaring back. I have a suspicion also that this month end, there's been a lot of talk about some big rebalancing being going on at the end of May and stuff like that. So I have a feeling that we might get back to the kind of the bigger trends as we head into the summer months, but who knows? However, we have some great topics to talk about. And the first topic comes from a beautiful piece that you wrote, and I will link to that in the show notes today. So please just head over to the show notes on the website, and you will find the link to Alan's latest writing. It's an interesting topic because Rich and I actually took a stab at it in a different way, where we just said, let's just do something completely quantitative. But you're talking about selection of managers and how we need to kind of overcome the behavioral biases that we have. Well, I wouldn't say we, but most people have. And especially when it comes to selecting managers, we know that that these play a very significant role in who gets picked and who doesn't. So I'm curious if you could kind of set the scene for the paper, and then I might politely interrupt you along the way
Sure.
with some thoughts and some comments.
Yeah. No, obviously, I guess the background on this is, I suppose, something from my experience as an allocator and interacting.
It's your wheelhouse, as we talked about.
That's right, yeah.
Before we press record.
And also, obviously interacting with a lot of investors, and, the experience of being part of a team allocating to managers. You observe these biases, and it's not a case of us and them. I think that these are challenges everybody faces in making investment decisions, and a lot of the focus from the behavioral finance literature is obviously on how these influence in our asset selection decisions, and trading, asset allocation, and even a lot of the Howard Marks note that I alluded to earlier is around the psychology of a bull market, and how we get influenced by biases and things like fear and greed. But where obviously this was relevant for me is as a manager, as a selector, an allocator, and selecting hedge fund managers, and particularly hedge fund managers focused on the managed futures sector. Equally you have these biases, and everybody's kind of aware of them, and it's something that we talk about in the allocator series a lot with the guests. But are there strategies you can try and put in place to try and mitigate them? And that's really what motivated me to write this paper, to try and say, okay, here's 5 things that you can try and build into your investment process. That you acknowledge that we're all going to have these biases, but these strategies might help you overcome those natural biases that we all experience. So, I mean, thinking about, what are the biases, there's a whole literature on this, so I'm not going to go through 20 or 30 different biases, but there are those out there. I think when selecting managers, the big challenge I would say is that people struggle with the random nature of returns, and this is probably one of the things that I noticed to a large extent dealing with investors. If you say if a manager is down or a portfolio is down, and you just say, well, it's just by chance, it tends to be a pretty unsatisfactory response from an investor's perspective. There always has to be a reason, like, well, it's down because of X and Y and Z, and we think they need to do this or that. And I suppose this challenge of dealing with randomness is linked with one of the main biases that we have, and that's I suppose what you might call the narrative fallacy, that we're very often seduced by narratives to explain things. So when actually things are just random phenomenon, humans have a natural inclination to try and put a story around it to make it more understandable. So when you think about that from kind of a manager selection perspective, when managers are doing well, there's always a narrative around why that's the case. It might be the case that, we've done some research and we've invested in a new system and it's working well and we've figured it all out now, when in reality maybe the market conditions have just become more favorable for the original system. Or when a manager is underperforming, then there's a concern, is something broken, and I guess the classic example of all of this, the narratives, and we've talked about this before, is maybe the performance of the industry generally, going back to 2019, and the narratives that were in the market then around trend following. The narrative was that there's too much money in the space, there's too much money pursuing trend following, central banks can control the markets. I heard that from a number of, sophisticated investors saying, well, I don't think we'll see big moves like we have in the past because the central banks can dampen volatility. CTAs are too slow to react to price moves. The markets have sped up. These were all narratives that were put forward. Very few people said, well, it's just random. We're just sampling, the negative tail of the distribution. I heard very few people putting that forward.
And if they did, they probably would lose the allocation, right? Because what you touch on is very interesting, especially from a kind of systematic trend following point of view, maybe more so, I think, than other strategies, because one of the narratives that we could say in earnest would be, well, there are just fewer trends around at the moment, right? But people have no idea what that means. And we could say, well, the environment for trend following is not great at the moment. And again, people would not really know what that means. And this is actually why back in 2007-ish or so that I was part of developing this trend barometer.
Yeah.
Because no one could explain what was going on with performance. They couldn't visualize it. So the trend barometer that we post every single day on the Top Traders Unplugged website is a visual representation, the best we can, in terms of what does a good environment look like and what does a bad environment look like. And I can share with you that some of the biggest $100 billion plus firms in our industry came to me back then and asked, can we have your data? Because we can't visualize this to our clients, and we really would like to be able to use your data. And of course they could. So I think it is especially challenging for us when it comes to this randomness, because the best explanation we can give is not satisfactory for our clients in most cases.
Yeah, absolutely. And I think, as you say, there were a number of papers around it. I wrote a paper around that, but it wasn't the only one. And a number of people reached the same conclusion, that you could very clearly see that the opportunity set for these strategies hadn't been as good as in the past. We hadn't seen the same kind of big moves, big trends. And but it is interesting how some narratives are more seductive, I guess, or are more compelling, that easier to latch on to than others. So certainly that was a good example of kind of the narrative fallacy. inability to deal with randomness and recency, and I think there's that natural, which is the other big bias that I write about, in the Howard Marks note that I alluded to. He writes about a quote from Kenneth Galbraith, and it mentions the extreme brevity of the financial memory, which is a really nice way of describing it. That for whatever reason in financial markets, that we people are so apt to extrapolate recent conditions and assume that things that happened far in the past won't repeat. Whereas, a lot of what we've been talking about here is that, failure of imagination to think about how the world may evolve. So narratives, inability to deal with randomness, and then extrapolating recent performance are all kind of top of the list in terms of things that can make allocating to managers difficult. And you see it on the asset allocation side too. Morningstar do a study called the Mind the Gap study, which shows, in broad terms, say if historically the US stock market has delivered whatever 10% annualized, investors have actually gained about 8% or so. I don't know the exact numbers, but the fact that they come in and out of the market at the wrong times, basically chase performance, means that there is a gap between what investors have actually realized and what the asset classes have delivered. And you see the same phenomena, obviously, in terms of managers and hedge funds, that people will tend to obviously move into a manager and allocate after performance. And it's kind of that the recency bias isn't just that we tend to weight the recent performance more heavily. That's one aspect of it. But it's also the fact that even if you kind of like a manager, you've done all your due diligence, you think there's a compelling investment process, etc. If that manager is underperforming, there's always a sense, well, we might just wait to see it working, before the allocation is made. And people found that with, allocating to managed futures as well. People say, oh yeah, I can see the case for why it can be in the portfolio, but we're just going to wait and see it starting to work again before we allocate. So there's that. It's kind of another manifestation of the recency bias.
And if I can just, add to that, just two other things, and I don't know if you will recognize this or not, but the other thing is, of course, the way we as managers often see the recency bias is the fact that when investors come into our product, right, and they do their due diligence, they would look at the whole 37-year track record, right? They want as much data as possible to analyze. But then when it comes to suddenly redeeming, it's based on like, okay, you had 6 months in a row where you lost money, so, it doesn't work, so we're out.
Yes.
And that is just very interesting to see how getting in requires decades of data, getting out requires only a few months worth of data, so to speak, which is a completely, crazy, I guess is the word I was looking for. The other thing, and very much to your point, is a point that I've come across even this week before I had read your note. And this is the thing, there's no doubt that there is more interest in trend following now than we have seen for quite a while. No doubt about it. And I was discussing this with people that I talk to on a regular basis about, have we seen any inflows yet? We know the interest is there, but have we seen any inflows yet? And the argument I was met with was, well, the performance is great, has been great for the last few months, but there's been other periods like this. So at the moment, they felt that investors want to see a few more months of good performance. And I was thinking, what is that going to change really? Because even if we have another 3 good months, you're still going to make an investment at a point where you have no idea what's going to happen after that.
Yep.
So back to the point you made, people just want to see a little bit more for whatever reason. And I think that is also just a sign that they don't really understand the strategy, and what they're doing is they're buying performance.
Yeah, absolutely. And that's another example of inability to deal with the random nature of how the returns will arrive. You allocate to trend following because you believe it has a place in a portfolio, or it's all your portfolio, depending on your perspective. And because you believe this is a strategy that can work over the long term in multiple market conditions, but it's very hard to say when those market conditions will arise. So equally, you'll have people saying, oh, we've had a strong period of performance, we'll wait for a little bit of a dip to buy in. So you have multiple different perspectives and biases there as to when's the right time, when in fact, most of the time the best time is now, and then deal with the volatility. I think related to all of this, when selecting managers is another interesting bias that you find, and possibly more on the discretionary side, but it's what you call representativeness, and that very often there's and this is selecting people on the basis of stereotype. So if there's a stereotypical manager with the right pedigree, and he's worked at the right banks, investment banks before, and that kind of background, there's a natural inclination to say, Daniel Kahneman writes about this, that basically it's selecting by using a mental shortcut. So instead of saying, okay, does this manager have the track record, all of the skills, the investment process put in place, that there's a compelling reason why this person has an edge in allocating risk and managing risk, you might take a mental shortcut and say, does this person look like a manager who has that ability? So it's a subtle difference. And, how does that come about? And it comes about, again, from the fact that people will have a narrative around why somebody may have an edge. But it's about disseminating or dissecting the narrative and really looking at, I suppose, evaluating the investment process as much as the outcome is the way to kind of overcome those narratives. So I talk about all of these things at a high level. The main point of the paper is really to kind of put forward some strategies for overcoming these biases.
But that's going to be super fascinating. We're going to jump into that in a second. But I want to ask you something personal as well before we do so. And that is, which of these narratives or biases, I should say, which of these biases were you and your colleagues mostly falling into yourself, would you say?
Yeah, I think all of them are. I think that what I find interesting about this whole area of behavioral finance is that we can have a conversation around this and say, well, we all know about recency, we all know about representativeness and narratives, and yes, that's a very valid perspective. But it's almost like people agree and acknowledge it at an intellectual level. But it's can you keep that in your mind at the moment of the decision making and say, well, now am I being vulnerable to any of these? And that's why I think the strategy for overcoming them isn't just to say, well, I'm aware of them, but you have to kind of build something into your investment process that kind of formally asks you to stop and think about them. Because, otherwise you can say intellectually, oh yeah, I know about these things, but they don't apply to me, but they will. So, obviously it is hard to, it's obviously hard to allocate to a manager who might be underperforming, even though you may have a belief that that is just down to pure chance. I mean, you can overcome that with your own analysis and say, well, so for example, if we went back 3 or 4 years, trend following managers who allocated more to commodities, and particularly the ags, were probably underperforming. Now, you could see very clearly that we weren't seeing strong trends in those markets. So there was a good reason for that underperformance. So there are things you can do, but at the same time, it is still difficult to do that, to buck the trend, so to speak. I think that's definitely one thing that is just very difficult for all of us to overcome. But I would say it's not a case that it's not a case that this is just a retail phenomenon. I think sometimes there's that perception, oh yeah, you've got smart money and, not smart money or retail money. But what was interesting from my experience over the years is large institutional investors are just as vulnerable and susceptible to these biases as anybody else.
Yeah, no, I agree with that. I agree with that completely. So I'm obviously very excited to hear about the solution to all of this, because there are, I think, 5 of those.
That's right. So I mean, a lot of it is will seem like common sense, and it is, but it's about embedding it in the process. And the first thing is what you touched upon is looking at long-term performance data, because there is this natural, I would say, default of kind of 2 to 3 years as the kind of performance time period that most managers are assessed over. And we certainly would have experienced that in previous roles as well, that you would be worried that if you start posting kind of a negative or an underperformance number over the 2 or 3 year time window, that could lead to concerns from consultants and the like. But it doesn't really make sense when you have this rich set of data that all gives you information about the manager, that tells you how the manager performs through multiple cycles. So, obviously certain strategies may work in a particular market environment, so some strategies might have benefited, say, from a market environment characterized by QE, others may not. That's very evident for some kinds of strategies, like a tail risk strategy will clearly do well, obviously, when you get a sharp, sudden burst in volatility. But the point is not to have that, I suppose, 2 to 3 year time horizon, and to go back and look at as much performance data as possible. The second thing is that very often managers will have 2 or 3 programs, and they may have a program that they started and they buried because it didn't work. You have to factor all of that into the assessment of the manager's track record, because somebody could just start 10 programs on day one, and over time, by chance, one of them will obviously be the best, and then they could just market that one. So you have to take into account past failures. You have to take into account strategies that haven't done as well, and that all of this builds out a picture of a larger data set. And so basically, the larger the sample size, the less likely your manager selection is going to be influenced by chance. But you do need a lot of data to start to grow confident that it is actual skill over just chance.
Can you think back of examples? Obviously, don't share any names here, but can you think back of examples where you feel now in hindsight that we definitely pulled our investment too early? Here's a clear sign of us reacting because the data in the short run wasn't as good as we would like. And also, I imagine that even though you are, quote unquote, in your life have been an allocator, you also have clients who might say to you as an allocator, say, what is that manager doing in the fund? He's been doing bad in the last 12 months. So it's not like you don't have the pressures like we do.
Yes.
In terms of just doing the right thing and sticking with your with your process. So is there anything that springs to mind?
Yeah, I think there's a couple of things around that. One is, yes, I'm sure there have been instances of that coming, later to a manager than you would have liked, and then the environment changes. I think if you run a multi-manager portfolio, you're solving for different market environments. So you may add a manager who will do it well in a particular market environment, and the environment might subsequently change, but you may well have another manager, a set of managers who will do well in that environment. And that's the whole point about building maybe a multi-manager portfolio. The second thing is, like, often you see it that the managers themselves just end up exiting the industry at the wrong time. And
right. I mean, and again, not really to name any names, but we do know of a multi-billion-dollar fund that was known for being a trend follower, and who decided 3 or 4 years ago to reduce the trend following part of their product. And he has said to the press that this decision will be hugely important for the future of the firm. And of course, he didn't know whether he was going to be right or wrong. But it came at a time where trend following performance had been challenged for a couple of years, but no more than that. And of course, in hindsight, it doesn't look like it was the right decision.
No, you're right. And equally, we saw, a couple of firms go out of business or decide to scale back or become family offices, etc. Just at that point where, if they could have stayed in the game, would have been very much favored by the environment. So it's not just coming from the investors. I mean, sometimes that is because they've lost assets from investors. Sometimes it's just a lack of, ultimately it's a sense that maybe that the environment isn't going to change. There's another point you touch on there, which is slightly to the side of all of this, is that in periods of poor performance, there is often this pressure from investors to respond to it. And again, this comes back to the randomness point. It's like, oh, the manager is underperforming, so what are they doing about it? And again, if you say nothing, that tends to be an unsatisfactory response, because we're conditioned for, if something's not working, we got to work harder at it. We got to do more of it. It's like the classic, football manager type analogy in the team. If the team's not being successful, they need to try harder, do different tactics or something. Whereas with and obviously an investment program, if it's just by random, if it's just that the market conditions haven't been favorable, you don't want the manager to be changing the program dramatically. If you're confident that that's the case, and that can be a difficult one to manage as an allocator with your own clients, because there is that sense of, well, what is happening now? Obviously, you do expect the manager to be reviewing everything. You do expect him to be reassessing everything, but widespread changes in response to losses is typically not what you want to see.
I would say, from speaking from personal experience, that is probably the biggest pressure that I felt from potential clients in the last 3 or 4 years, is the fact that we, as a long-term trend follower, we don't change the models very often, because every time you make a change to your model, there's a chance you're going to get it wrong. And so the lack of a new narrative, something new to talk about, this piece of magic research that we've just found and we're going to implement that next week, that lack of things was very, very evident that, as you exactly said, investors were looking for a quick fix, right? A solution, saying, well, if you do, why haven't you done anything, right? And it's obviously proven, and I think people can see it now, that the right thing was to stick with your knitting and not make any changes, because, as you point out, it was just, quote unquote, random that our particular time frame, maybe, or the markets we traded, were pretty quiet for a couple of years, and then suddenly they take off again. Obviously, I'm sure many of our colleagues would have felt the same. So I think that is a real issue that you point out there.
Yeah, so I guess the second thing then, related to all of that, and from the perspective of the narratives, is trying to cultivate a skepticism towards narratives in the team, the selection team. I think, if you think about how most people approach manager selection, it's generally, okay, this manager is delivering strong performance, let's try and understand it. But if you approach it from the other side and say, okay, here's some manager, let's start with the null hypothesis that the manager has zero skill. Can we reject that null hypothesis? And that would, which would be indicative of skill. So it's a change in the mindset, but it does put you in a much more of a neutral position in the first instance with respect to the manager, as opposed to the opposite approach is almost assuming the manager has skill, and then you're trying to understand, well, why that's the case. So I think that's it's important to be skeptical of narratives, because, as I say, in any period of performance, the manager will typically have a story. Everybody has marketing teams, and they want to give explanations as to why things are going better than they have been. But that narrative may not be the reality. It may just have been that, it mightn't be down to a new system or a new model that's been introduced. It could be that the older models have just been performing better because market conditions have improved. So I think that skepticism is something that obviously experienced allocators developed over time. This is something that we would have talked about in the allocator series with the likes of Chris Schelling, who was saying, if you just meet one or two hedge fund managers, you're going to be bowled over by their expertise and success, etc. But if you meet 100 managers, you'll have a better sense of understanding the narratives that you hear and being able to question them. So that's the second thing. I think the third thing is then obviously looking at the process as much, if not more than the outcome. We naturally tend to start with performance, But if you didn't look at performance at all, then you would be making assessments on managers on the basis of, do they have a process in place or an edge? In my paper, I touch on a quote from David Swenson around this as to how managers have an edge and what you should be looking for in terms of making that assessment. But that's really the way to assess managers in the first instance, is nearly even ignore the performance data and meet the manager, the process, and say, well, is there a compelling reason ex ante why this manager should be able to deliver alpha over time based on what we've learned? Is there something in terms of their access to data, their sophistication around trading, their experience, that would say, okay, this manager is somebody who could deliver alpha over time? And then secondly, look at the performance and is that return generation consistent with what you would expect the pattern of performance to be? So again, it's kind of putting things in reverse: performance second, process first.
Yeah, no, absolutely. Just on the point you mentioned prior in terms of the skepticism, it actually makes me think of something where for the longest time we've been discussing on the podcast about trend followers lacking a narrative, right? And we've been kind of seeking what is a better narrative for trend following.
Yes.
And because, and I think this is like, we had on the podcast, we had Ben Hunt on the Global Macro series a few weeks ago, and he's obviously the expert in narratives, and he talks about how Bitcoin has become Bitcoin, right? It's like, Bitcoin trademark, like it's in order to be accepted by everyone and by authorities and allocators and all of that, you've kind of invented this framework so it fits better into the narrative, etc., etc. And now that I hear you talk, and it's actually something I thought about the last couple of days, is that maybe we're doing it completely wrong. Maybe we as trend followers, we shouldn't try to fit into a narrative. Maybe we're better off being the little nerdy black sheep, so to speak, of a strategy that most people won't get and will never allocate to, because we will serve our clients best and we will serve ourselves best if we simply just embrace the quirkiness and the randomness of our returns and the bumpiness and all of those things that we know deep down people don't like. But this is actually what makes the strategy unique. And therefore, we shouldn't care about trying to make changes to smooth it out or something else that we know investors would like, because we might get a better Sharpe ratio, God forbid, things like that. So I don't know if this makes sense or not, but I do think to some extent that maybe we should care less about the narrative and just stick to the core of what it is we do and not worry too much about what other people think about it, so to speak, even though it may mean that we get fewer assets as an industry. Yeah,
no, I think you're right. I mean, it's kind of that there's a realization, I guess, that as you say, you were talking on with Ben Hunt, that how influential narratives have become, and Robert Shiller has a book around all of this narrative economics, that it can even swing the economic cycle, that because people's behavior will be driven by the dominant narrative. So obviously everybody in the industry is trying to run their business and raise assets, etc. So they're trying to put forward a narrative that is compelling, but it has to be consistent with the nature of the strategy. And I think the uncomfortable thing is that, as I say, is that there is a random element to the return series, and that's maybe that's not an interesting narrative for some people, or maybe that's a narrative that doesn't resonate as well with some people. So there's a natural inclination then to try and think of a narrative that's maybe more digestible for investors. So I think maybe that's the challenge there. But it comes back to this lumpiness of the return series, or random nature of the series, as you say, we know it's a strategy that works over the long term. You just don't know which month, which quarter, which year it's going to do particularly well.
Yeah, no, absolutely. But we're not finished. There's a few more, a couple more.
Last two things very quickly, and I think they're quite interesting, because we can learn from other disciplines around, decision making. So the one is the idea of doing a pre-mortem. It's very common in whole project management. So what you do is at the start you say, rather than doing a post-mortem when something goes wrong and you try and figure out what happened, in advance you do a pre-mortem and you say, okay, let's think of everything that could go wrong and let's plan for that. So in the same way, when making an investment allocation decision, you typically think, well, okay, we like this manager, we can see the case, we like the process, we think they have an edge. But it can be beneficial to turn that around and at the point of allocation say, well, okay, let's do the pre-mortem. Let's say what could go wrong. What are the range of outcomes that we're likely to see, and within that to set, well, what do we think is a reasonable expectation in terms of drawdown? Because in drawdowns are inevitable in investing. So when the drawdown arrives, it's not a knee-jerk reaction of, oh my God, this hasn't turned out the way we expected. At the point of allocation, there should have been an expectation that there will be a drawdown and it should be of a certain magnitude, and there should be a kind of a probability distribution as to how things play out. So it's to think, I suppose, more probabilistically about the allocation, and within that to think about the downside risk and specifically the range of scenarios that can generate negative returns, so that when they arise, that it's not a knee-jerk reaction, oh, we need to get rid of this manager because they're suffering losses. Instead it's, no, this manager is down, struggling, but we expected that they would have something like that at some point in the track record. So I think that's a very important one in terms of planning for multiple scenarios. And then the final one, I think, is just in terms of the decision-making process around all of this in selecting managers. Individual people will be subject to different biases. So it can be very beneficial for people to do independent research. And again, there's an insight from, if you're doing brainstorming, if you do brainstorming, to say, don't get 5 people in a room and then just try and brainstorm, because what will happen is the first person will dominate, or the first idea that is put forward tends to dominate, and that steers the discussion. What you should do is get the 5 people to write down their ideas independently, and then everybody reviews them. So in the same way, from a manager selection perspective, it's better if people do their manager analysis independently, go on site, make the assessments independently, and then are not biased by the person who went before. And I think that from my experience, that can be very valuable in terms of different people will pick up on different aspects of the manager and their experience and possible risks, etc. So again, a lot we can learn as allocators from other disciplines like project management, decision making, etc. And it's all about trying to embed this into an investment process so that you're basically forcing yourself to address these biases head on.
Yeah, no, I mean, as I said, it was a beautiful piece, which of course I encourage people to go and download in the show notes. And it obviously also, it showcases something that we have to acknowledge, and certainly us as managers, and that is our clients have a pretty difficult job.
Yes.
In terms of selecting managers, we definitely have to be sympathetic to that, even though we sometimes are surprised by their choices, let's put it that way. But yeah, we have to recognize it's not an easy discipline, but a very important discipline, that's for sure. Alrighty, so on that note, actually, in terms of allocation, you could say, you pointed out a Barrons article regarding the 60-40 portfolio. Now, unfortunately, I'm not a subscriber to Barrons, so I couldn't read the article, and I'm pretty sure many of our listeners is in the same position as I am. So maybe you can summarize what it's all about, and then we take it from there.
Yeah, the piece was written by a Barrons journalist and about the demise of the 60-40 portfolio, or this perception now in the market that model has to be changed. It came to my attention, one of our previous guests on the Allocator series, Phil Huber, is quoted in it in terms of the shift away from 60-40 into more alternatives. But a bulk of the article is around a paper that KKR have written on this very topic, saying move over 60-40 kind of thing. The new model is 40-30-30. So interesting how this, everybody's kind of saying 60-40 is dead, but the new model is kind of up for grabs, I suppose you would say. The KKR perspective on it is that there are amendments to be made both on the equity side and on the bond side. So their preferred solution is taking 20% out of the equities side and putting that into private real estate and private infrastructure. So 40% equities, 10% in each of those two, and then on the bond side, taking 10 out of the 40 to go into private credit. So ultimately, you've got 40% equities, 30% bonds, and then 30% in privates, diversified across credit, infrastructure, and real estate. So obviously, we've been talking a lot about 60-40. We've been talking about trend following managed futures as part of the solution. So I did think it was interesting. There was no mention of any of that. But one of the things that they talk about in the paper, which I think was a good way of doing it, is they talk about like why did the 60-40 come to prominence, or what are the roles of the different components. So basically, obviously, you're looking for capital appreciation, then you're typically looking for income, and so the capital appreciation from the equity side, the income from the bond side, and then having something as a buffer that can do well in times of stress. So the bonds basically has a dual role of generating income and this buffers / diversification. So you might think then, where would, if you were to allocate to trend following in a portfolio, where would that fit in? And, I suppose you could argue on both sides of it, because, I would say for the last kind of 10 years or so, people typically allocated to managed futures and trend following for the diversification quality, particularly after, 2008, and we're seeing it again now. But also, I guess, in an inflationary environment, as we're seeing, that trend following can be a source of capital appreciation as well. So certainly, how many assets and strategies out there have the ability to generate positive performance when both bonds and equities are down? Not many. Certainly trend following has been shown, trend and macro and managed futures have all been shown to do well this year, and historically we've seen that. So I think, it is interesting that, when you look at the reasons, the building blocks for the 60-40, the growth, income and diversification, okay, you wouldn't typically get income from managed futures and trend, but certainly you can see the role there from the diversification side and possibly the growth side. And I suppose my other observation on this is with the 40-30-30, and with allocating to something like private credit, you are doubling up, I would have said there, in terms of equity beta or economic beta, in the sense that if you have a severe economic downturn, you wouldn't really expect something like private credit to provide a whole lot of diversification. So that's more. It's a bit like what we talked about with Hugo at Rothschild about having a lot of cabins on the same ship. It's kind of in the same cabin of risk asset. So I thought interesting perspective. Wouldn't agree with it. Obviously, I would see a role for diversifying strategies like trend and managed futures and macro in there. But I think in making the case for the strategies that we like, we can focus on those elements, the building blocks, to say, well, you want something in your portfolio for growth, you want something for income. What are the strategies for diversification? Well, very clearly, trend following would be one of the close at the top of the list from that perspective.
Yeah, I mean, it always surprises me that some people will come out and even suggest that you get any diversification from investing in the same underlying, but just now we call it private, right? I mean, how much diversification are you really going to get, whether it's a publicly traded bond or a privately traded bond or fixed income product? And that's really concerning, because I think it lacks an incredible amount of respect for the unknown and how the environments are changing. And it gives, I think, people a false sense of diversification, which they will, I fear, find out at some point if they were to follow this kind of advice. So that's one thing. Of course, Rich and I took a stab at the 60-40 as well,
yes,
like everyone else, where we just basically said, let's find an alternative to the 40. And I think it's the pinned blog post on the website. And then we follow that every month when we report. How is that doing? And it's doing absolutely fine, so to speak. And then on top of that, I just want to mention that one of the things that that I look at in my day job is, in order to, because we always get the question, how much should I allocate to trend following? And of course, it is a moving target. You can't really say what is the optimal. So just for the fun of it, I look at this portfolio with 4 different starting points, but where you can invest in stocks, you can invest in bonds, and you can invest in trend following. And the starting points, I want them to be extreme. So you have a starting point before the tech crisis, and a starting point after the tech crisis, and then before the great financial crisis and after the great financial crisis. So 4 really extreme starting points to see what happens with the allocations to each asset class at those points. And what I will say is, because I've been doing this for a while now, what I will say is that it changes a lot. And right now, if you look at, I think it's from the great financial crisis, both before and after, there are very little bonds now, right? Because the last 10 years, bonds haven't returned a positive return at all, actually, or maybe a very slight positive return. So it's dominated by equities and trend following. But of course, a few years ago, you would have more of a bond allocation. But again, I'm, like you, certainly not a proponent of just moving from public equities to private equity. And I think, unfortunately, a lot of people are tempted to do that, because if they look at the return stream of private equity, it looks better. But if anything of what I worry about is going to fruition in terms of a deglobalizing world, et cetera, higher interest rates, higher inflation, all of those things, I mean, I think private equity could be one of the biggest sufferers, actually, of that regime change. So it is worrying.
Yeah, I think the other thing to point out with a lot of these articles that you see, looking at how these different versions have done historically, obviously anything, if you go back 10, 20 years ago, interest rates were higher. So anything that was fixed income related will look much better, because the starting point was a much higher yield. Obviously, yields have risen a bit now in the last 12 to 18 months, but still, low in a historical context. And obviously, real yields are very negative. So you have to be very careful with some of these with the analysis that show, well, if you change to 60-40 and add 10% to the strategy, it makes it look better. You have to think, well, what are reasonable return expectations for those assets and strategy in the context of low interest rates?
Exactly. And what are the real risks in the context of a world where interest rates are probably going to rise, or more likely to rise than they are to fall significantly from here? So I think those are great points that you point out. But you also brought along one other article, and of course I can add to that, because there were actually 2 articles out this week in the press that were kind of positive when it comes to trend following and so on and so forth, which we don't get much positive press, let's put it that way. So we were kind of, I think both of us, latching on to those and wanting to highlight them, but maybe for different reasons. So I'll let you go. I'll let you go first. I think on the I think this was the FT, the Financial Times article.
Well, I mean, when you see trend following on the front of the FT, it's always interesting. I would say generally it hasn't been positive news going back. The last time it was maybe a number of years ago, but it was a positive story about the strong performance of, well, it described as quant hedge funds in 2022. And the journalist Lawrence Fletcher, I mean, he's covered trend following before. He covered what we talked about, the challenges back in 2019, and he's written about that too. So good to see him coming back to the topic and highlighting the good performance this year. What was interesting from my perspective, I saw he had posted it on LinkedIn, and then there was a number of kind of questions about it, which were very typical of the kind of responses you often see from people around trend following. And it's like, are these not quant strategies, and AI, should they not have adapted, and why did they have the bad performance for 10 years? So it just was interesting from my perspective that that these things that we're talking about are still very much out there, misperceptions around what trend is, what it isn't, what are adaptive strategies, what are not. And also that as we've talked about before, that this perception that the trend has been doing badly for a number of years seems to be still out there, even though, as we know, 19, 20, 21 have all been decent years for trend following. So interesting that the industry is getting some press for the good performance, but also interesting that these misperceptions around what is trend following and managed futures still remain out there.
Yeah, absolutely. There's a couple of things. So you're absolutely right. It was Lawrence Fletcher who wrote the FT article, and he starts out by writing, trend-following hedge funds, which use mathematical models to try to predict market movements, had struggled for years in an era dominated by central bank bond buying, a stimulus tool to suppress much of the volatility on which they thrive. But the $337 billion industry is now making its biggest gains since 2008 financial crisis, according to data from hedge fund research. Now, the headline, and I forget the headline as we're speaking right now, but there was something about biggest gains or whatever, and then it had something like after the dead decade. So I took the liberty, and maybe I didn't come across nice enough actually when I did, but I did tweet back to Lawrence to say that I didn't really like the after dead decade in the sub headline, because when I look at the peers that we compare ourselves to in our industry, I can certainly see that a number of the peers are up more than 100% since 2013, so more or less the last 10 years, and I can see on our own returns that they're even better. So I don't really call that a dead decade when you look at returns like that. And then he kindly replied and saying, well, of course, there's always going to be exceptions, right? So, yes. Okay, fair enough. So there we are. But I also wanted to point out to him politely, of course, is that it is wrong to talk about that our models predict market movements. We don't predict anything. And so these are important things to get out, because if we finally get some positive press or some narrative coming out, we need to make sure that at least it's representing what we do correctly. So those were the things. I didn't get a comment back on that particular point. Great to see that Lawrence and the FT is writing something about the strategy. Sometimes I wish that they would just reach out and talk to people from the inside before posting their article, just to make sure that there weren't something that maybe could be, changed. But, one of his colleagues, of course, the Robin Rickenworth from the FT, the now the new editor of Alphaville, was on the podcast a couple of months ago. After I had a chat with him about his book Trillions, which is an interesting book for sure. And I couldn't help towards the end of the conversation ask about his own relationship with trend following. And I think that, from memory, I think he said that, he does like quant strategies. It's really something he's interested about. I don't know that he's a specialist in trend following. And I think he felt also that these kind of, what we talked about earlier today, the lumpiness of the returns and all of that, made him less excited about the strategy, which I think is a shame, because it really is one of those strategies where you have decades of evidence, decades of data to support it, which you can't really say about most hedge fund strategies today. So it's a shame, but we'll keep fighting the good fight and so on and so forth. But there was one more article that I don't know if you'd seen this one perhaps, but that was from Barrons actually, and that was I think on the 26th of May it came out, and it was just heading "Managed Futures Funds Look Like a Smart Bet in a Tough Market." And of course, that is a perfectly fair comment. And the article basically just explained what trend following is, and I think it did a pretty good job of doing so. And it comes back to this point that we talked about earlier, that maybe it's fine that we don't get too much press, because we shouldn't really try and let the narrative dictate how we should design our models, right? We should just stick to what we do. And if people like it, great. Yeah. If they don't, That's fine.
Absolutely, yeah. Now, I think the difference now is that if you go back a few years, you had to paint a picture for people as to a market environment that could be favorable. You say we could have geopolitical risk, we could have inflation, we could have rising rates, divergences in the economic cycles across countries. So you don't have to paint a picture anymore. It's very evident that that's the environment we're in now. So I think, so from that perspective, that narrative is a lot easier for people to understand and appreciate.
It is and it isn't, because I still feel that a lot of investors, and maybe also people in the kind of financial media, are expecting that things will go back to quote unquote normal. So anything before COVID, let's call it that, and certainly anything before the Ukrainian war would be considered normal conditions. The stable, globalized world that we all know and we all remember, because that's the world we've grown up in. That's the norm. And this is the exception, and we're going to come back to it. But as I don't know if you and I talked about it before, certainly I've talked about it on the podcast, that what I worry, and of course I could be completely wrong, but what I worry about is actually we need to zoom out, and we need to think about maybe the last 70 years after World War II, and certainly the last 20 years in this sort of Kerry regime as the abnormal period. Because if you go back in history, Europe is not a safe and stable place. The world is not a safe and stable place. So what if the whole narrative is wrong? What if we are thinking about this in the wrong way, where we're sitting there? It's almost like buying the dip, right? We're thinking that buying the dip is the norm. That's what will work best over time. But what if actually it's selling the rally now? That will be the best strategy for the next 30 years, right? I'm just painting an extreme picture here, of course. But I don't think I'm painting necessarily an extreme picture when it comes to how the world will change, because I think it's very hard, for me at least, it's very hard to imagine that things will go back to the way they were before. There's just simply too many things that have changed. There are so many things that we have uncovered, or at least it has become known now by many people, that there are real challenges with having a globalized world and the security that world lacks when it comes to energy, when it comes to food, or the weaknesses, I should say, in those things. So I'm maybe thinking a bit the completely wrong way. I don't know, but that's how I feel at the moment. That we're still hoping things will go back to quote unquote normal.
Yes, yeah.
I just don't think that the normal that people are hoping for is the real normal, and that we're heading back to this more uncertain world, more volatile world, and in a world where divergent strategies will have much better conditions compared to the convergent strategies, I guess.
Exactly, yeah. No, I mean, you're right. I mean, if you go back far enough in history, you see these cycles of globalization and deglobalization, back in the late 19th century up until, what about the 1920s? That was a period of great globalization and world trade, and then it gradually unraveled through 2 world wars, and it only came back then in probably since the 1980s, I guess, 1990s.
And another thing that I think we don't talk enough about, but we will talk about it in a few weeks in one of the new episodes we're doing, actually, which we recorded yesterday. But then there's this whole reversal of demographics that's happening, which we can't stop. I mean, this has nothing to do with sitting at a negotiation table saying, oh, let's just agree to stop demographics, right? No. This is coming. And the change in demographics around the world has a huge impact on inflation and other things that are linked to that. And I don't necessarily know that people are thinking about it in the right way. But I don't want to take all the thunder out of the guest's argument. But that is another thing that I feel needs to be rethought in terms of going back to the normal. Because when demographics fundamentally change in the world, things can't go back. Well, they can maybe in a few generations, but not in my lifetime, that's for sure. And I don't think we're thinking about that. Back to your point earlier that we talked about, we need to be more imaginative about what can happen. And I'm not sure we're there yet, as they say in Shrek.
Absolutely.
Are we there yet? Any final thoughts on all of this before we move on to a little bit of a performance update and wrapping things up?
No, I look forward to hearing that. I mean, I agree with you on the demographics. It's something that has been put forward. Charles Goodhart, I think, had a book around that.
That is the co-author of that book we recorded with yesterday. It's a fantastic episode.
Yes.
So you are in for
There's
a treat.
There's a lot of very
sure.
interesting topics, not just the demographics, but also, about aging and how, the number of people that will be required for health workers basically will ratchet up over time. And because demographics is such an interesting one, so often you hear, it thrown out as part of the disinflation argument. You say, oh, well, demographics, that's a disinflationary force, but is it really? When there's many dimensions to it when you get into it. So very much look forward to hearing more on that. Oh yeah, no,
you're up to speed on some of those arguments, but I think when people heard it, I was listening to it yesterday. This is being recorded with another host, Kevin Coldiron, whom we had on as a guest. But when I was listening to it yesterday, I thought, that is not what I expected. So I think a lot of people will get the same feeling when they listen to the argumentation. So that will be out in a few weeks as we launch the new Ideas Lab series. In the meantime, though, performance is, as I said, a little bit softer this month, but it's pretty good actually for the corrections we've seen in the markets. We're holding on well. Beta 50 index is actually, as of Thursday, still up 44 basis points, up 15% for the year. SocGen CTA index pretty much unchanged, down 11 basis points for the month, up 19.25 for the year. SocGen Trend Index also pretty flat, down 0.25%, up 25.6 for the year. And the SocGen Short-Term Traders Index up 35 basis points for the month, and up 9% for the year. I think yesterday was maybe a little bit of a down day, but nothing much really. As I mentioned, Trend Barometer, it's weak at 34. The MSCI World obviously had a strong week, so we're back in the black for the month, up 0.25%, but still down 13% for the year. And the World Government Bond Index just slightly up 6 basis points so far this month, despite the rallies we've seen in the last week or so. I'm going to wrap up this conversation. And of course, if you enjoy these conversations or any of the episodes on the podcast, we would be ever so grateful if you would take the time to rate and review the podcast in iTunes and Spotify. We had some really nice ratings and reviews coming in this week. So I want to acknowledge that, even though I'm not going to name names here, but I do read every single one of them. So and we do appreciate them. Next week, Rich is back from Down Under. So I'm sure you can guess we're going to go into some hardcore trend following, I'm sure. We've had some good discussions in the meantime, and I'm sure we'll come up with some good topics. But if you want to have a question answered, perhaps, or a topic discussed, you can do so by emailing us at info@toptradersunplugged.com, and we'll do our best to bring it up on Saturday. That leaves me to say, from Alan and me, thanks ever so much for listening. We look forward to being back with you next week. And in the meantime, as always, take care of yourself and take care of each other.
Thanks for listening to the Systematic Investor podcast series. If you enjoy this series, go on over to iTunes and leave an honest rating and review. And be sure to listen to all the other episodes from Top Traders Unplugged. If you have questions about systematic investing, send us an email with the word question in the subject line to info@toptradersunplugged.com, and we'll try to get it on the show. And remember, all the discussion that we have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their products before you make investment decisions. Thanks for spending some of your valuable time with us, and we'll see you on the next episode of The Systematic Investor.